Have you ever wondered whether index funds or ETFs are better for your investment portfolio? With both options offering low fees and passive strategies, how do you choose between them? Whether you're just starting out or have been investing for years, understanding the key differences can save you money and improve your returns. Let's dive in and explore which option, index funds or ETFs, is the best fit for you. Index funds versus ETFs, the basics. Both index funds and exchange-traded funds, ETFs, are powerful tools for building wealth. They allow you to invest in a broad range of stocks, bonds, or other assets at once. Whether you're looking to diversify your portfolio, save on fees, or take a hands-off approach, both options can be great. But what exactly are they? Index funds are mutual funds designed to track a specific market index, like the S&P 500. They're often praised for their low cost and passive nature, meaning they don't require constant management. ETFs, on the other hand, are also funds that track an index, but they trade like individual stocks on an exchange. You can buy and sell ETFs throughout the trading day, just like you would with company shares. Now that we've covered the basics, let's compare the two more closely. Let's talk about how are they similar to each other. Number 1. Diversification. Both index funds and ETFs allow for easy diversification. They pool together many stocks or bonds into a single investment, reducing the risk that comes from owning just one stock. For example, a total stock market fund can give you exposure to nearly 4,000 companies in the US alone. This is a huge benefit because it spreads your risk across multiple industries and companies. Number 2. Low fees. Another major benefit of both investment types is their low fees. Compared to actively managed funds, index funds and ETFs cost much less because they simply mirror an index. For example, the average expense ratio for index equity mutual funds in 2022 was just 0.05%. For ETFs, it was slightly higher at 0.16%, but both options are much cheaper than actively managed funds, which typically charge fees around 0.66% or more. Number 3. Passive investments. One of the key reasons people love index funds and ETFs is that they're passive investments. They don't require you to pick and choose individual stocks or constantly watch the market. Instead, they follow a set index. For long-term investors, this is a set-it-and-forget-it approach, perfect for those who don't want to spend their days tracking stock prices. Number 4. Strong long-term performance. Historically, both index funds and ETFs have delivered solid long-term returns. While some actively managed funds might outperform the market in the short run, over the long term, few managers beat their benchmarks. Index funds and ETFs, which simply track the market, have shown steady performance. For example, the S&P 500 has delivered an average annual return of about 10% over the long term, making both investment options reliable for patient investors. Now, let's take a look at how are they different from each other. Number 1. Where to buy. When it comes to accessing these investments, there are some differences. Index mutual funds are often available in 401k plans and other retirement accounts. However, ETFs are less likely to be offered in such accounts and are more commonly bought through an IRA, Roth IRA, or a taxable brokerage account. If you prefer the flexibility of buying and selling throughout the day, ETFs may be your best option. They can be traded just like stocks, whereas index funds can only be bought or sold at the end of the trading day. Number 2. Investment minimums. Another difference between the two is the minimum investment required. Index funds often come with higher minimums, which can be a barrier for new investors. For instance, Vanguard's VTSAX, a popular index fund, used to have a $10,000 minimum, though this has since been lowered to $3,000. In contrast, ETFs typically don't have high investment minimums. You can buy a single share, and in some cases you can even purchase fractional shares through online brokers. Number 3. Trading fees. When it comes to trading costs, ETFs generally have the edge. Most major brokers have eliminated commissions for trading ETFs. Meanwhile, index mutual funds can have trading commissions, and some even charge load fees, extra fees added when you buy or sell the fund. ETFs avoid these load fees altogether. However, it's always important to review all the fees involved before making a decision, as some index funds may still offer competitive expense ratios compared to ETFs, despite the added trading costs. Number 4. Tax strategy. For those looking to manage their tax burden, ETFs have a unique advantage. When you sell shares of an ETF, you're only responsible for paying taxes on your own gains. With index mutual funds, you're part of a pool, and if the fund manager sells assets for a profit, you may have to pay taxes even if you didn't sell your shares. This gives ETFs a slight edge for investors who plan on buying and selling frequently. Which is right for you? So, how do you choose between the two? Choose index funds. Index funds might be your best option if you prefer a hands-off long-term approach to investing. They are great if you're looking to invest through retirement accounts like 401k or IRAs, as many of these plans offer index mutual funds as standard options. Index funds allow you to buy and hold without worrying about daily market fluctuations because they are only traded once per day at the end of the trading session. This can also help curb emotional trading, as you're not tempted to buy or sell throughout the day. Index funds are also a good choice if you're investing a larger sum, as many come with minimum investment amounts. They're ideal for those who want steady growth over time, without the need to actively manage their portfolio. Choose ETFs. ETFs are a better choice if you value flexibility in your investments and want more control over when and how you trade. Unlike index funds, ETFs trade on stock exchanges throughout the day, meaning you can buy or sell whenever the market is open. This makes ETFs perfect for investors who want to take advantage of daily price movements. They're also a great option if you're starting with a smaller amount of money, as you can buy individual shares and even fractional shares through many brokers with no large investment minimums. ETFs can also be more tax efficient, which is helpful if you plan to buy and sell frequently. Another advantage of ETFs is that they often come with even lower fees than index mutual funds, making them attractive for cost-conscious investors. Final thoughts. The choice is yours. Ultimately, the decision between index funds and ETFs depends on your investment goals, trading habits, and tax considerations. The two types of funds share many similarities, but their differences can impact how you manage your portfolio. The good news? Both index funds and ETFs can serve as excellent options for growing your wealth over the long term. Whether you're just starting out or already building a portfolio, both offer low fees, diversification, and a passive approach that's perfect for busy investors. So, which one is right for you? The answer may be a mix of both. Many investors use a combination of index funds and ETFs to maximize their benefits. What's most important is that you start investing and take advantage of the power of compound growth. By now, you should have a clearer understanding of the differences and similarities between index funds and ETFs. Both offer great ways to invest your money with minimal fees and long-term performance. Remember, the most important step is getting started. Whether you choose index funds, ETFs, or a combination of both, you're making a smart move toward financial success. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell so you never miss a future update on investing tips and strategies. Thanks for watching.